Hello and welcome back to Equity, TechCrunch's venture capital focused podcast. I'm TechCrunch reporter Kate Clark, and I'm joined by my co-host Alex Wilhelm of Crunchbase News. How's it going, Alex?
It's going good. Cold out here on the East Coast. Looking forward to fall, but otherwise in good shape. And I'm really excited about our guest this week.
Yeah, we have a special guest with us today, Sarah Smith, a partner at Bain Capital Ventures. Thanks for joining us.
Thanks for having me. Super excited to be here.
We have a couple of fun facts about you. First of which is that you are a competitive strategy board game player. And before the show, I actually got some tips on stuff to buy. I'm pretty excited about. But more importantly to me, you are a Packers fan.
Yes, big Packers fan. I didn't grow up a huge Packers fan, even though I'm from Wisconsin. But when I moved to Austin, funny enough, that's when I really became a Packers fan. There was a bar there called the Star Bar. But on Sundays, it became the Bart Star Bar. And that was pretty great.
Nice.
All right. Well, so I want to make Packers jokes, but it's not really a sports show. So I'm going to hold it.
Not really.
It's sometimes a sports related show, but today is not one of those days. So I'll just say fly, Eagles, fly. And we can move on
Go Pack, go.
To a really great piece, Kate, that you wrote this week that I'm honestly, I loved reading it. I learned a lot. So do you want to take us through liking and subscribing as a venture capitalist?
Sure. So yeah, I wrote a story about venture capital investment in the creator and influencer economy, or maybe more about how I think there'll be more of it coming.
I want to ask a question about creators versus influencers, because as someone who's no longer on Instagram, I'm a little bit cut off from this world. And I know that it's gotten to be very large and very important, very culturally impactful. But an influencer is someone who is essentially famous in the modern sense and therefore has an impact on the market's view of certain products. But a creator is different, Kate. Is that true?
Yeah, so there definitely are differences between the two, and I know some people are really sensitive about that. There is a lot of good stories. I mean, Taylor Lorenz, who has covered the space, obviously, and she's a prolific reporter on internet culture. She's written a piece, you should read it, The Real Difference Between Creators and Influencers, that explains it. I mean, I think influencers, people do associate that term with people who post on Instagram for ads, and then creators are more people who are artists producing content on, across platforms.
But I think your point on like what are influencers, like I think that's expanded dramatically over the last few years. Like we used to think of only like Selena Gomez or Kim Kardashian being influencers, and now I think people with like, even a few thousand followers can start making money online. So they would also call themselves, I think, an influencer if they can monetize.
There's a big spectrum because there's celebrities who are certainly influencers. There's even athletes who are now kind of their own set, they're influencers. But then there's people like you mentioned who have a few thousand, and that those are referred to as micro influencers, people with like, I think maybe more than 3,000. That's a constantly changing definition.
But going back in time, the idea of micro influencers isn't entirely new, because there was a service that would pay you to post on Twitter way back in the day, like 5-7 years ago.
Yeah.
And you could get on, I think it was Isaiah or something like that. And you could do a paid post for a very small dollar amount back then with only a small smattering of followers. So I feel like this is just the same idea, but much better and more professional, it sounds like, from a product perspective. Kay had a bunch of companies in the post, like Mo Assist, which now has raised 1.2 million K, and that was the project management side of this. So what's the goal there? What is it trying to do?
So that one's interesting because it's actually created by an influencer, which is something I noticed. There's so many things happening. There's like entrepreneurs who are more classic Silicon Valley techies who are building in the space, and then there's influencers like people who for the last 5 years have been, doing digital ad campaigns on their Instagrams and made enough money that they decided to build some sort of company related to it. And so that one was founded by a woman named Danielle Bernstein, who was like a street style photographer, blogger turned like super influencer turned now she's starting a tech startup. It's just like I said, project management and payments platform to just specifically help influencers because they have sort of unique business needs and they need support in a different way than many entrepreneurs would. Yeah. So the point of that is just to kind of help out people like her.
Yeah, it's pretty interesting. It's like I was looking at the site. They a lot of these influencers that, let's say they have like, I don't know, 500,000 followers, like they were on The Bachelorette 5 years ago or something. And exactly. And so then they have a lot of like there's a lot of specs that they have to fulfill in order to actually get the bounty. So if they're doing a sponsored ad for like Walmart or Tom Shoes or whatever, they'll get almost like a mini RFP from the brand saying like, hey, take a photo with this product or make a video and then make sure you mention these 2 things and then send them to the site. And if you cross all these boxes, we'll pay you XYZ. And so it's hard for them to keep track of all of the specs for all of these different little, these posts that they're doing. And then for them to actually go invoice afterwards.
Right.
That's the part that was interesting to me about this company, kind of to the point of like everyone's kind of getting into payments and so forth. But
Totally.
this is a big part of, I think, what the value prop is probably for the influencers.
Yeah, they need to get paid. And I think there's such an unreliable industry, as is any kind of like creator job. Like if you're a freelance journalist or any kind of contractor. So that's meant to help with that. But yeah, I mean, I think another lesson learned is a lot of these founders I talked to, ones that have successfully or unsuccessfully raised, said there's still a lot of skepticism from VCs, particularly those outside of LA, where I think there's less talk about this influencer economy. And there's a lot of funny quotes. Like one guy basically was like, just talk to your kids about it. They'll explain to you the value prop here if you won't, listen to me. But I think, and I'm sure you have insights into this. I think there's more conversations happening around it.
Yeah, there's a lot of, I think to your point in your article too, there's a lot of people starting businesses around this because, definitely you see when there's a consumer wave happening, a lot of people kind of go, I know, I'll fix this problem I had and start a company. So we see a lot of people trying to solve the same problem. I think fundamentally the challenge I have is that it is very fragmented. So, this is like not even SMBs, this is like SSS, right? It's like very, very, very tiny folks. Yeah. So then you have to wonder, like, if they're making a few $1,000s a year, how much of that can you get them to funnel towards your product? Like, where is the money going to be? How big is the market? And I think you had mentioned there's something like $8 billion or something this year will be spent on online or on influencer marketing, which is, it sounds big, but when you look at all of online marketing this year, it should be about $330 billion of spend. So it's still a relatively small 2 to 3%. Now, my guess is actually just from early days at Facebook, we definitely saw that brands would feel like they got a lot more value out of people influencing their friends than just like the brand voice. So the impact of the dollars they're spending, that $8 billion, might actually be higher than average. And so you would expect that might rise. But still, relative to the entire ecosystem, it's a pretty small amount of total marketing spend. So I think that's where probably a lot of venture capitalists are still kind of sitting back wondering are you going to be able to extract and really, like, can you get to 100 billion? Like I was looking at her numbers, can you get to $100 million in revenue? She's charging $28 a month from these micro influencers and creators, $300 a year. It's like you got to get to 30,000 plus or so.
Right. And these are the questions certainly that VCs are going to ask. And another thing that came up a lot when I was asking investors about it is they said that they keep seeing the same thing over and over again. They keep seeing basically two-sided marketplaces, brands and influencers, which I think is a lot less interesting than like these new ones that are sort of like services built on top built on top of those. So even more tailored and unique things. I think the influencer marketing platform sort of came in like years ago. And at this point, we don't really need any more of those.
Yeah. But the dollar amounts we're seeing here are pretty small, like 1.2 million here, 25 to 50,000 checks for some podcasts. Like the amount of money is commensurate with the size of the market, back to your point. And that feels intelligent and good. I think in 2019, we've gotten so accustomed to seeing such large checks land wherever there's the possibility of some growth. Question though, if this first round does well for VCs, these companies that Kate mentioned in this piece, do you think we could see a relatively rapid increase in VC investment in the space, or do you think there'll still be enough doubt in the market about the viability of this economy, for lack of a better term, that investment would remain modest for another 12, 18 months?
I think it really depends how many dollars total are funneling over the system. So even though $8 billion is being spent on marketing, if those people are generating hundreds of billions of dollars of commerce, then that's really interesting because then you can start getting into the payment side of things. It kind of reminds me a little bit of like, if you think about like Shopify, when Shopify was early, like there were tons of tools available to tiny e-commerce folks, or even like Etsy. There's a lot of these like brands that, just through great UI, UX and like consistently delivering an awesome product, they just became a dominant market leader. So if there's definitely a clear winner in this space, I think you could see some of that moving forward, but it's all going to be how much purchasing are these people actually driving. And the nice thing for the influencers is we're still kind of in a world of a lot of last click attribution, and so they do get a lot of credit if they're sending people there. And so if they can get so much, if they're each of them generating $1 million or $2 of that, then the banking and payment side becomes really interesting.
Yeah, I think it's very early days still for so many of these companies, obviously. Like Carrot, for example, is probably maybe a couple months old. I don't know. it's brand new and they're just building. But I think there'll be a lot more activity, whether it's just a lot of entrepreneurs building projects or influencers turning into entrepreneurs. It'll be interesting to kind of watch and see what happens.
Carrot, by the way, spelled with a K. If you're Googling along as we go,
K-A-R-A-T.
And it's trycarrot.com because there's also a recruiting tool called Carrot. There's a lot of carrots.
Yeah, because there's fertility. The fertility startup too.
Yeah, there's a lot of carrots.
I'm not losing my mind then because I was like, I thought I heard of a different company called Carrot that was much bigger than this
There's
one.
a bunch.
There's like 7.
Yeah.
Startups get new names.
What's called zucchini? Come on.
Honestly, that's much more memorable than Carrot.
I would not forget a company called Zucchini. You're like,
I wouldn't
persimmon?
either.
Except it starts with Z, which is probably not great for search ranking.
That's true.
Yeah.
Apple.
I think we can leave that there. Let's talk about another millennial-ish focused company called Deserve. Now, Deserve raised $50 million this week, led by Goldman Sachs, which always kind of catches my eye when I see Goldman hop into a round. I presume the company is sufficiently financially mature to have a viable exit path in the next couple of years, which is always exciting to see. It implies that it won't go all WeWork in the end. And a $50 million round is always notable, just as a general data point. Sally May, Aspect Ventures, Pelion Venture Partners, and Mission Holdings also took part. And then I dug into what the company does. And if you're not familiar, Deserve is big in the student credit card space, helping people with non-traditional kind of like credit backgrounds get access to their first credit cards. And it also provides services to other organizations to let them issue cards to kind of like their group, if you will. And I think they call it CAS, which is Cards as a Service, which I think is 3 demerits for abuse of the SAS acronym. Here's my confession. I hadn't heard of this company before it raised. And so I'm kind of curious if either of you had heard of it before this news broke.
I had not, but it wouldn't surprise me if my partner, Matt Harris in New York, had, because he does most of our fintech investing and we've been putting a lot of time into the space in general. But no, it's definitely not a household name. They definitely don't have like billboards up at Caltrain like some other card companies.
I don't think, I actually just Googled to see if I'd written about it because I wanted to make sure I hadn't written about it before I answered that I'd never heard of it. But
or cafes.
It looks so much like other companies. There's a lot of consumer card companies that are raising money in the last couple of years. I've definitely written about many of them. This seems the same and it looks the same. So it's pretty difficult to say whether, I don't know if I've heard of it before.
That's kind of a diss, but I suppose what sets it apart for me, and I know fundraising is not a metric of success, but it can be a proxy for progress at times if you're in our chairs and you're not seeing access to the company's financials. So my impression is that because it did manage to raise this amount of money from whom it did, it must be larger than a lot of the other companies that we've seen in the space over the last couple of years. So we could be looking, possibly with a lot of caveats, at kind of the market leader. I'm kind of curious how big they can grow the business to business side of their business, because if it's all just consumer oriented cards, they kind of do it on a one-by-one basis. That's a really competitive market. But helping other companies give out cards could be much more lucrative, bigger contracts. To me, there's more growth there. I don't know. It's kind of a weird hybrid consumer B2B play. I don't know if VCs are like that sort of thing these days.
I mean, we love fintech. In fact, we're in the place now where my partner, Matt, we're in a place where we think like you won't even call it fintech as a vertical anymore. It'll be like saying it's an internet company. Like almost every company now is doing something with embedded payments or some way to capture part of the value chain. We actually invested in a company called Finix that's doing specifically this, like helping software companies do more with embedded payments and having basically fintech be part of the stack. So we're huge fans of the space in general. I think the point on the consumer side is like you do wonder just about customer acquisition costs. And that's actually the reason why so many other companies are going into it, is that they've paid all this money to acquire customers. And then now, here's another whole huge pot of potential revenue to take advantage of these customers you've already spent so much to get onto your platform.
Okay, let's talk about CAC for a minute, because I think it was Green Dot, which is a public bank, or it's a publicly traded bank, I should say. And I think it was 1 or 2 earnings cycles ago, noted that their growth rate on the customer side was slowing because so-called neobanks were spending so much money to acquire new customers that they were struggling to compete at a higher CAC price point, for lack of a better phrase. How material is that trend, and from your perspective? And then also, has it gotten worse lately? Because I feel like it comes up more often now than it used to.
Yeah, I think our view is that it's gotten much, much worse. I mean, online spend, basically a lot of people were free riding for a long time on really low CACs. I mean, I was at Facebook early days when we first launched the auction system, and people were paying pennies a click for, really high value conversions. And so it just took a while for essentially the market to shake out. But as a result of that, people are kind of used to the old days of low CAC, and you can kind of work your way through growth by just spending more and more and more on online ads. I think that party is over. So now people are looking for alternative means. And that's where, a lot of these software companies, it's sort of like, hey, we brought you in for an influencer tool, but why don't we also sell you a credit card or extend a line of credit for you? And then they can get that bounty from a financial institution, or in this case, maybe even have their own card, right? Which is, I think, the idea behind this.
Right.
Well, this is a perfect segue into kind of the other thing I wanted to talk about today, which is almost exactly that. It's companies that started off in kind of one part of what I would call fintech or fin services, and have expanded their product line to include things like, quote, high yield savings accounts. Everyone wants to give you a debit card. And my read of this was there's just so much available revenue there that why wouldn't you go after those other things? But I didn't think of it from the perspective of, we already spent all the money on acquiring these customers. Let's just juice that revenue. I was thinking more forward, but that makes a lot more sense financially because you already have people there to use the stuff as it is. If you're Betterment or if you're Wealthfront or I don't know, Robinhood or whatever.
Yep. It's like sunk cost. So you might as well just continue to monetize and add to it. Like Shopify's, and we talked about that a little bit earlier, but that's like a really interesting example. If you look at their business and what they were monetizing in the early days was software. Well, now payments and payments facilitation has become we think will be the majority of the revenue very, very soon. So we think that trend is going to continue across like many, many companies.
Because Shopify has two main revenue streams. They have a general kind of SaaS product, which is like the service that you pay for. And then they also take a cut, I presume, or some take rate off of payments and other stuff that flows through the platform.
Okay. Yep, that's right.
So they're like a non-pure SaaS business that looks better than a SaaS business in some ways then, which is a weird turn of events because usually that's not the case.
Well, unless that turn of events is fintech.
So that's the lesson.
Then you look awesome. Yeah, exactly.
I feel like by starting to pay attention to this part of the market in the last 2 weeks, so I'm very behind all this. I've uncovered an enormous amount of activity that I just wasn't paying any attention to. And I got to catch up on this because Chime, everyone knows, right? Which is I want to say not the OG neobank, but certainly one of the biggest ones by total number of kind of current customer accounts. But I don't know. I was slow to catching on to everyone else driving into this. So as a question, how long ago did this pile on into savings accounts and debit cards kind of begin from your perspective?
Oh, that's a good question. I mean, we've really been talking about this in earnest as a thesis, I would say this year, but my partner, Matt's been investing in fintech for like over 10 years. So I think he saw this kind of rightfully so a lot sooner than the rest of us. I don't think you're like that far behind. You shouldn't feel too bad. But I think what is interesting is you will start to see more and more, like almost every company that you look at will have some angle on payments or embedded payments as part of their business plan. And increasingly in earnings calls too, like I think like Uber's talked about Uber Money, right? They're starting to add that. And, I invested in Lime and looking at the scooter space. Interestingly, there was a company down in Brazil called Yellow. They ended up merging with Grin to create Grow. But part of the most interesting thing about the business was actually they were collecting payments in order for people to ride scooters, and that involved people going to small kiosks to pay for basically a debit card almost to ride a scooter. So the payments business was actually more interesting than the scooter business in that case. So it's just this thing that's happening kind of all over the world, not just in like the US, but also in other like underbanked countries.
Yeah, I mean, Uber has been a fintech company from the beginning and has always had one of its best products is its frictionless payment capability. Wait, Alex, did we talk about this last week? Because I don't want to have the same conversation again. But did we talk about Uber Money last week? No? Cool.
Nope.
So yeah, Uber Money, this kind of fits into the conversation. They announced they have a team in place. I think I was reading over some reports and people had noticed for a long time that they had been hiring in New York, basically hiring really smart former Wall Street people or people with financial acumen to bring on to actually build out their financial services products and build better products for their drivers, to sort of incentivize drivers and give them better abilities to actually track their payments and then essentially bank with Uber. So that's interesting too, because I think we'll see Uber do a lot more now that they've kind of have a publicly announced team working on the stuff.
Yeah, I was gonna say similar to the influencer, like this rise of a bunch of small platforms for influencer tools. Same thing with the gig economy. There's a ton of stuff too, trying to help gig economy workers manage their taxes, their payments, their cash inflow and outflow. I think it's kind of a similar fragmentation.
So I got a question about this before we talk about Uber's earnings and then wrap. But like when people pile into a space, generally speaking, the price of the good they sell goes down because competition lowers the price for consumers. If everyone's piling into high yield savings accounts, I presume we'll see rates for consumers go up, which is a good thing. But can payments revenue that everyone's chasing with interchange and so forth, kind of owning the piece of the stack, as you said, will that be a race to the bottom? Or do you think there's enough defensible revenue there that even if everyone piles in, it'll still be kind of a lucrative idea or a lucrative play for these companies?
Yeah, I think the pie is going to grow a bit, but in general, the pie is just getting split up. I mean, I think it was pretty concentrated for a long time with the incumbents. And so people are just eating away at the incumbents, but there was a lot of money to be had there. So we believe that there's a lot of big companies still to be made.
So this year, according to PitchBook, it was by far the most funding into fintech companies, which broad, but believe it certainly. Do you think that's going to keep happening for several more years before it sort of peaks?
That's a good question. When will it peak? I mean, we believe it's really early innings, I would say, in general. Okay. Like, this is not, like, to your point, you kind of only really started hearing about this. I mean, we think there's a lot more room for innovation, and there's also just a lot more data now. So, like, the whole risk profile of how you think about offering credit, a lot of these models are based on new metrics that old banks, never felt comfortable. Like, how do you quantify Instagram followers as, like, something that you could potentially monetize? Yeah. I mean, there's just a lot of interesting new data streams that could come into play here.
But Kate, you talked about that in your story about Carrot, right? That they were going to do
they said
lending based on.
Yeah, sorry, no, exactly. And I never talked to the company directly because I think they probably didn't want to respond to me because so early. But their website does say things like, what if you could use your TikTok following or your YouTube following to, as evidence of whatever it was to be able to get a loan. Of course, you can't do that today. They want to see your W-2. They want to see these other traditional statements, but this company is saying, if you want to borrow money from us, we can look at that and use that as evidence that you're good.
Not to be rude about the idea, but Kate, you and I have more Twitter followers than the average person. Sarah, I don't know how many you have.
Sorry. Now you can go buy a house.
But that's the thing. I don't think if our following went up by 10%, Kate and I, that we would have 10% more money or 10% more credit worthiness. Like I'm slightly leery of these things. Yeah,
and you're not the first person to have the reaction today. I've heard from a number of people who said things like that or made a joke of it. I mean, clearly there's more than just that they would be looking at. I'm not defending the company because I actually have no idea how they're going to do this, but I don't think they're going to be like, oh, you have 25,000 followers. Okay, here's your $2 million. I mean, there's going to be a lot to it. And we're not creators or influencers. We're like an old-fashioned thing called reporters. I don't know what box that was.
I mean, here we are creating and influencing, so I don't know.
They could do something like Clearbank, though, if you guys have seen Clearbank, right? Where they say, hey, hook us up to your, hook us up to your Mo account, and we want to see how much revenue you're generating, and then we'll, grant you credit based off that, right?
Yes, definitely. Because they want to invest in high-growth creators and influencers. They don't want to just invest in anybody that has a big TikTok following.
That's the best typo.
So you have to have, there has to be some evidence there that you're kind of, the theme of the article, or the point I was trying to get across is like these startups are treating influencers like they are a small business, and they're giving them the tools that they need to be a successful business, small or medium or whatever. And in some cases that means, venture backing. In other cases, I think it means revenue share. In other cases, maybe it's a grant. I don't know, because Patreon, I mentioned in there, is now doing like a $50K grant to certain people who, have the right metrics or whatever it is. So there's just a lot of different, I think, ways people are innovating to support.
I mean, the other last thing that's pretty interesting about this, though, is that also I would guess that the average age of these influencers is also pretty young. Mm-hmm. So some of it's capturing these consumers like early in their, frankly, like many decades long financial life cycle. So that's also a super valuable group of consumers to have.
Yeah, go ahead.
Oh, by the way, going back to what I was saying earlier, I don't think it's dumb that people might have a higher credit worthiness with more followers. If you can find a way to math that out, that's super great. I don't mean to make fun of it. I'm just saying personally,
how do you underwrite it? Yeah, totally. There's a lot to, there's
a little mind-boggling.
Not a lot of historical data to show you've got like some models built out yet.
Yeah. Kate, shall we close with 30 seconds on Uber's earnings?
Take it away.
All right. What is spelled Uber and is down 7% today? Look, it's Uber's stock. Bad day for Uber. This is my attempt at transitions when I make them up on the fly, and all it really does is make Kate laugh and me blush terribly on the video. All right. Anyways, Uber stock is down after reporting earnings today because the company lost more money than expected, although on adjusted profit, it did beat, and it did beat on revenue. The only thing I want to bring up is that the growth business at Uber is particularly unprofitable. So Uber Eats was the fastest growing piece of its adjusted net revenue. And it turned, if I recall my notes, about $3.6 billion in gross spend into negative $315, $316 million in adjusted EBITDA, which is not great. Just throwing it out there because we covered their IPO so much. And if you're an on-demand company, that's not what you want to see today from Uber.
The lockup also, I think, is over today or tomorrow, very soon.
Yeah.
So that's also going to probably wreak a little havoc.
That will be interesting to see how that plays out.
All right. I think that's it for this week. Kate, good to see you. Thank you for coming on, sir.
Yeah. Great to be with you guys.
Thanks for
Super fun.
All right. See you sometime soon.